If I had to think about one thing that really scares me, that's it. You see a circumstance where if the Fed doesn't intervene, the interest rate wants to go higher. If they had trouble at 7, they're going to have a lot of trouble at 9. The market might now look at the Fed and say, you don't have the ability to do what it takes. If you bail out the system, you have to print.
Special coverage from the floor of the Rule Symposium is brought to you by Palisades Gold. I'm at the Rule Symposium in Boca Raton, and here with me is none other than Rick Rule himself, the host of the conference. What a terrific conference it's been so far. Thank you for hosting us, Rick.
David, thank you for coming down. The best is to come. You'll see.
Absolutely. This is only the first day. Now you're the co-founder of Battle Bank. You're the proprietor of Rule Media, and you're the former CEO of Spot US. So a lot of people have followed you all the way from across the globe to attend this conference, having followed your storied career. I've just jotted down your resume, a short description of your resume. Now, what can we expect at this conference? What are the main themes that are different this year versus last year?
Well, let's start by what we expect.
Yeah.
We bring people down here and we work them really, really, really hard. This is a 4-day conference, but we interview every exhibitor before the conference. Mm-hmm. The idea being that we want our attendees to arrive at the conference ready to allocate their time and resources more efficiently than they do at other people's conferences. Every single exhibitor here has been vetted, which means if we don't own the stock, they can't appear on our floor. We accepted 68 exhibitors and we turned down 135. There's no other conference I know of in the world that will turn down a check for an exhibitor, but we will. And that allows us to say to our attendees, if for any reason, whether you attend live or live stream, you don't think you get your money worth, we'll give you your money back. There's a lot of promise in this conference that you don't see other places.
So what do these 60-something companies have that the 135 you turn down do not? And we'll talk more about picking stocks later on in this interview, but general guideline, why are they here today?
There's different kinds of companies, so there's different reasons. Agnico Eagle is here.
Yeah.
Well, first of all, because they've exhibited with me for 20 years, and I've owned them for 20 years. But I think Agnico Eagle is the best-run senior mining company in the world. That's reflected in their all-in sustaining costs. It's reflected in the fact that their employee turnover is a third of their peers. If I don't own the stock, it doesn't appear on the floor. Simple as that. I own different stocks for different reasons. I own Wheaton Precious as an example, not a speculative stock, high-quality stock. That's why they're here. Other companies exhibit different risk profiles. There's a lot of prospect generators here. I own them because although the probability of success is fairly low, the reward for success is fairly high.
Can the same not be said of any junior?
There are some juniors that have been effectively de-risked with the drill bit. As an example, Snowline is here. This is not a recommendation to buy Snowline, but the truth is there's no mystery in it. There's no mystery there anymore. It's a large deposit that's certain to grow. It's high grade. It's a deposit that will either get bought or it'll get built, one or the other. What I'm trying to say is with Snowline, the answers to the questions that are proposed begin with when, not if. Those are very high quality questions. It exhibits a different risk profile than an earlier stage explorer. A risk profile to be sure, but one that with regards to the data has been de-risked. I said in interviews with you before, David, that there are probably 3,000 junior mining companies in the world, and probably 85% of them are valueless, meaning that you have to be a good enough student of the game that you throw away 85% of the companies before you find the 15% that you can focus on. Uh-huh. We try to focus further. We try to find companies that are in the top 2 or 3 percentile in the juxtaposition of risk to reward, irrespective of the risk profile.
It's not a mystery that gold has come down from its highs. It's also not a mystery for those of us observing the space that sentiment in this mining space has come down significantly from just a few months ago, Rick. We talked about this a lot, but it's interesting for me to observe that even though the price point of gold was exactly the same, maybe last October or something like that, sentiment is completely different. How can sentiment be completely different at the same price point?
I think that people are emotional rather than rational creatures. Yeah. Developing a rational approach requires work. An emotional approach just requires feelings, and it's easier to feel than it is to think. But most people do what's easy. We try here to teach people how to think. What you point out is probably the greatest part of this timing. I was afraid in December and January of this year that I would assemble 68 great companies and have to say from the podium, these are 68 great companies, but none of them are cheap. The fact that the junior resource market is sold off by 40%, and the fact that the bad companies and the good companies are sold off in frankly equal measure shields me from that problem.
Mhm.
I can say we have 68 exhibitors and there's some spectacular value on our floor. That spectacular value exists because the sentiment in the sector is bad.
Yeah. We're entering the second half of 2026. Fundamentally, for an investor, not just in the metals and mining space, but just any investor, how do you expect the second half of 2026 to impact your portfolio differently than the first half?
I suspect it's going to be very soft in the second half for two reasons. I think there's less pressure on the U.S. Fed to lower interest rates. I think ultimately they will, but I don't think they'll have to in calendar 2026. That means relatively strong U.S. dollar. That means that things that are denominated in U.S. dollars, like gold, will be soft in terms of price. I also think, and I'm making this next part up, David, so I hope you people don't take me too seriously, but I think the recent conflict that we had in the Gulf acted like a tax. And as you know, I think all taxes are bad. What happened with high oil prices is that we took a lot of liquidity out of the economy. And I think the economy in the second half of 2026 is going to surprise people with its weakness. What that means is that I expect, as an example, the copper quote to be flat to down. I expect what you're seeing in the oil market because the high oil price, among other things, killed some demand. So I suspect that 2026 is not going to be kind for people who are impatient. For people who are patient, I think that you're going to have the ability to buy names that are high quality names, that you're going to have enough time to study them before you buy them, and you're going to set yourself up to make a boatload of money in the out years.
Mm-hmm. What about financial stocks? Given that interest rates are rising, do financial stocks usually perform better or worse during a rising interest rate environment, especially when the yield curve flattens out?
Rising interest rate environments traditionally are lousy for conventional financial services companies.
Okay.
I think it'll depend on where you inhabit that ecosystem. There are, and this is not in this particular instance an advertisement for Battle Bank, there are some community banks in the U.S., small banks, that know their local market well, serve their local market well, have no loan loss experience whatsoever, selling at 60% a book and earning 10 or 12% on capital after tax. That's a 15% after tax earnings yield if you buy it at 60% a book. That's a no-brainer. I mean, it's an absolute no-brainer. And those are banks that traditionally are run by bankers who serve through good interest rates and bad. Most people get bored with the concept of the property and casualty insurer or a community bank. Mm-hmm. But the idea that you can buy a 10 or 12% stable after-tax yield at 60% a book, pretty attractive. Those companies will do well.
One thing I've learned from talking to countless investors over the years is that people spend a lot of time searching for certainty, the perfect signal, the perfect entry point, the perfect moment to act. But markets rarely work that way. In fact, many of the smartest investors I've interviewed weren't successful because they waited for certainty or the perfect entry point. They were successful because they acted when they had conviction. And that's especially true when it comes to something like gold. Many people have followed the gold story for years. They understand the macroeconomic backdrop. They see why central banks continue to accumulate gold, and they understand the concerns surrounding government debt, deficits, and currency debasement. But understanding an investment thesis and actually positioning for it are two very different things. Today, more investors are deciding to take a closer look. Some are purchasing gold directly. Others are moving a portion of an IRA or a 401k into a gold IRA. That's why today I partner with Augusta Precious Metals. What I appreciate about Augusta is their commitment to education. They explain how their process works, answer your questions, and help you evaluate whether or not precious metals make sense for your particular set of goals and situations. No pressure, no hard sell, just information so you can make an informed decision. So if you'd like to learn more, visit lintrustsgold.com, link down below in the description, or scan the QR code here, or text LIN, L-I-N, to 35052 to receive Augusta's free information guide.
There are some risks that we have to discuss. I think you've discussed the possibility that mom and pop owned high yield bond ETFs could trigger what could be a run of the bank, except without the FDIC to backstop it.
Yeah.
Yeah, can you tell us more?
If I had to think about one thing that really scares me, that's it. You see a circumstance where if the Fed doesn't intervene, the interest rate wants to go higher. It wants to go higher. And higher interest rate does a couple things. It hampers the ability of stressed creditors to pay. If they had trouble at 7, they're going to have a lot of trouble at 9. And it also constricts credit. It also devalues the long bond, because that long bond can be replaced at a different interest yield. If you are already experiencing credit difficulties, higher interest rates are difficult for you. In answer to your specific question, what scares me is the high yield ETFs, the junk bond, or the subprime credit ETFs have literally trillions of dollars of assets, and many of them are owned by people who don't understand the credit risk that they're taking. If people begin to have credit concerns and begin to sell those ETFs, the ETF structure itself is highly liquid, but the assets in the ETFs aren't liquid. The manager will have to sell assets which he or she can't sell to fund redemptions, which they must fund. That's where the run on the bank comes. There are some high yield bonds that were sold over the counter in these ETFs that trade once every 6 weeks. If you have to push that bond into the market overnight to fund a redemption, the price that you're going to sell that bond for is going to reflect your distress, not just the market's distress. And that really scares me. Really, truly scares me.
But the trigger for that would be much higher rates, you think?
People are already concerned about private credit markets.
Yeah.
If people's concern extends from private credit to junk credit, which it might, I'm not saying it's going to happen, but when people ask me what makes me the most afraid, I'm afraid that many retail investors don't understand the risks that they're running in their high yield bond portfolio. They don't understand the credits that they're writing. And if something happens like 2008 that causes them to be concerned, if they head for the exits, there's no exit.
But this concern is specifically for high yield bond investors. It's not a systemic risk that could propagate into other sectors.
Well, it could. If you have a circumstance where high yield ETFs gate, where they don't fund redemption, the nervousness that creates in the broad market, and I'm not saying this is going to happen, but if it happens, you revisit 2008. You might not, at your age, have been cognizant in 2008, but we had a real test of system failure. Mm-hmm. That's a character-building environment.
One could argue the entire system didn't collapse because the governments did backstop several large institutions.
That's exactly correct.
We can expect the same thing to happen again, right?
Except that in 2008, the aggregate debt of the U.S. federal government was about 40% of GDP. Now it's 120% of GDP. One wonders about the tools available. The Fed was able to say in 2008, we will do whatever it takes. The market might now look at the Fed and say, you don't have the ability to do what it takes. You can't raise taxes. You can't increase the deficit. So if you bail out the system, you have to print. And if you print, that's going to be wildly inflationary, not merely inflationary. So the ability that the Fed has to intervene relative to the size of the problem is much lower now than it was in 2008. I'm not saying that they can't. And if it happens, they will. But the damage that they do to business confidence, to credit confidence, and in particular, to confidence in the sanctity of the US dollar is very, very risky.
So I guess the hard constraint here is inflation. There is nothing stopping the Fed from instituting unlimited QE like they did during COVID.
That's correct. What changes is their ability to fund it.
Right.
That's what changes. Remember that the debt to GDP, on balance sheet debt to GDP then, was 40%. On balance sheet debt to GDP is 115 or 120% before you take in the net present value of unfunded entitlement liabilities. There's much less flex in the system now.
unless somehow they just lend to the banks without monetizing debt, and the money supply doesn't really grow.
How? What's the instrument? I mean, the only instrument that works in that circumstance is something called a lie. And the market is not that naive. The market's fairly naive. But if the government says, we're going to kiss it and make it better, here's your kiss, where's the money?
So the bond market, the world's largest market after real estate, is telling us what now, Rick? If you look at the way spreads are behaving, yields are behaving, and
the interest rate wants to go up.
Yes.
And the government is doing whatever they can by buying the long end of the yield curve and financing it out of the short end of the yield curve. They're doing whatever they can to maintain their control over the yield curve. Right now, because people are concerned about the broad economy, there's a lot of people, myself included, who are willing to buy one-year paper. The government is financing one-year paper to buy back 10-year paper to lower the long bond yield. But the long bond yields are still rising. What that's telling you is that investors want a time premium and they want a risk premium.
Going back to your previous comment about the second half of the year being softer, which opportunities would that present?
That depends on the scenario that we face. I know you want a yes or no answer, but I don't have one. If we have a market, a panic-engendered market, you'll just have to see what's cheaper. When I look across the opportunities that are presented to me, the opportunity that's most attractive to me, probably because I know it very well, is the gold stock market. The gold stocks are, relative to the gold price, not cheap, but they're fairly priced. And they've been fairly priced maybe 4 times in my career. I believe, make no mistake, that over 10 years, the gold price, the nominal gold price, is going to be markedly higher than it is today. And I think the fact that I'm able to buy high-quality companies at fair prices in a market that I think gets inexorably better is very attractive. I think right now that the oil quote and the oil stocks are in free fall. And the oil market is a better market than any other natural resource stock. So if I looked at what I'm likely to allocate to the most over the next 6 months, it's likely to be the oil and gas business. I'm able to do that because I know a lot about it. I grew up in that.
Canadian oil and gas specifically?
I am more willing than most people to buy Canadian oil and gas because I understand the valuations in Canadian oil and gas. American investors need to decide how much carny risk they're willing to take. My belief is that although Carney is frankly hostile to the oil and gas business, I think, unlike your former prime minister, he can add and subtract. He understands that his domestic spending program requires revenue. And what Canada is better at than anything else is oil and gas. I think that he will have to be oil and gas friendly because I don't think there's any other way to fund his social program. And I think he understands that.
Mm-hmm. I think he has made some remarks recently that would support your point. He's trying to appease both sides, I think.
Yeah.
But at the same time,
I really pay less attention to what they say.
Mm-hmm.
I like that adage that you can tell when politicians are lying because their lips are moving. So I prefer to think about the fiscal and arithmetic constraints he operates on.
Yes.
More than what he has to say. I've been watching this guy for a very, very, very long time.
Mm-hmm.
He's a very bright guy. He's a very driven guy. Given that he got where he is, he's probably not a very honest guy. So I prefer not to listen to him, but rather watch him.
Let's talk about how one can find alpha in an environment where uncertainty dominates still. And I'm talking not just about gold and silver investors. I'm talking about any investor that is coming out of an environment which is the longest bull run in history, barring COVID. And all of a sudden now, when everything last year was topping and reaching new all-time highs, all of a sudden now in 2026, you're sitting there thinking, wait a minute, gold was at all-time highs. It no longer is. Silver was all-time highs. It no longer is. Ditto Bitcoin, ditto tech stocks, right? 3 of the 7 Mag 7 stocks have rolled over into negative territory year to date. So I'm scratching myself wondering as an investor, what's happening? Why are things no longer pushing all-time highs? If it was just a sector rotation such that we have one thing going to new all-time highs and one thing falling, that I understand. But it seems like everything is falling at the same time.
I'm ill prepared to answer that question. I don't own a TV,
Okay.
so I'm the wrong guy to talk to about popular culture.
Okay.
And I didn't participate in Bitcoin because I don't understand it, and I didn't participate in tech stocks because I don't understand those. My discipline involves studying a company that I believe is selling in the market for less than it's worth. In my discipline, money's made on the delta between price and value and price and expected value. When people say to me, Rick, what do you think about NVIDIA? I have to say, I can barely pronounce it. I don't think about it. I don't know anything about it. I can't comment about it. If you ask me about Franco-Nevada, I can say, I think that's the best gold mining company in the world. And I think it's selling at a discount to intrinsic value. So I can speak with somewhat more certainty. And I'm not saying that people should buy Franco-Nevada, but using Franco-Nevada as a way to teach a lesson, that's a company that I own a lot of stock in. And I hope it falls more in price so I can buy more.
Yeah.
That's a mark of true affection.
Okay. Did royalty companies look attractive when capital was even cheaper, when interest rates were lower? Did, because the options of going to a royalty company versus, I guess, going to capital markets was a little more competitive.
I'm going to argue that royalty companies do better during periods with high cost capital because royalty companies have access to capital at interest rates that are lower than the rest of the mining companies.
I see.
So the interest disparity means that their ability to allocate capital at relatively lower cost is higher during periods of higher interest rates. The traditional investor who will look at a royalty company will value their dividend stream at a lower multiple with higher interest rates. That will happen. But I believe that both the royalty and the streaming companies have the best 10 years that they've ever had in front of them in terms of allocation.
Yes.
Many people say that the big deals in streaming have taken place and that you shouldn't pay elevated multiples for the streaming companies because the transactions that cause them to be what they are aren't in the offing, and I disagree with that. I think the recent transaction between BHP and Wheaton, a $4.2 billion transaction, where the small company financed the big company, tells you that the ability to finance, as an example, great big copper porphyries by selling the byproduct gold and silver in streams means that the big transactions are ahead of the companies, not behind them.
Right.
And the difference in the cost of capital, the spread between the cost of capital enjoyed by Wheaton and the cost of capital enjoyed by Anglo-Tech or somebody like that, is such that my suspicion is that higher interest rates perversely will help the royalty and streaming business.
Interesting. Let's talk about the companies here to close off the conversation. We have a few minutes left. Are you expecting them, speaking of capital, are you expecting them, we're even hoping, we're prodding them to raise more capital now at $4,100 gold?
Most of them raised a lot of capital in the end of next year. One of the things I found fairly common with these people is they followed the old adage, the time to take hors d'oeuvres is when they're passing them out. Okay. And a lot of these guys were pretty aggressively passing the hat and don't need it now. And I look at some of the companies that I think of as little companies, Uranium Energy, with $700 million in cash on the balance sheet. You know, I think of this industry as capital constrained. And then I look at my issuers and they aren't capital constrained at all. At all. If you look at the length and breadth of the Canadian juniors, most of them are deservedly undercapitalized because most of them are crummy companies and shouldn't get capital at any rate. But if you have a high quality management team and you have a high quality project, the truth is those projects finance themselves in good markets and bad. So while I encourage companies to take money when the money is freely available, most of them have done that. And there's no need on my floor for most of those companies to raise it.
A company can't predict or rely on when the market's going to go up to raise. Most of them have a certain runway they have to adhere to, right? And so when you have to ask the question as to when to raise capital, what is the criteria? Is there a certain cash to asset ratio?
Well, I like to see the companies, even the exploration companies, have at least 18 months of operations funded.
Okay.
That gives them the ability to generate the news that they expect. And if I believe that there's a probability that they're going to achieve what they say they're going to achieve, it is likely that the subsequent capital raise that happens in a circumstance where the value of the company's assets has been established at a higher level as a consequence of the money that they already spent. But I also ask companies to raise money when it's easy, when they're handing it out. It turns out that the fourth quarter of last year and January of this year was a stupidly easy period to raise money, and the smart guys took it.
What about to acquire companies right now? Is now the environment you see to be engaged in M&A?
Strategic M&A. I mean, I define M&A two different ways: strategic and tactical. Strategic M&A means that you're acting like Agnico Eagle. You are buying assets where you have a lower cost of capital than the acquired company, and where by acquiring the asset, you can use that asset to amortize capital that you've already spent.
Yeah.
Those are strategic acquisitions. Then there are tactical acquisitions, like Equinox buying Orla. There's no strategic rationale for that acquisition. But the fact is that by putting those two companies together, you create a new major, a 1 million ounce producer, that will get index inclusion and passive buying.
Are there certain phases in the company's life that makes it less or more attractive to a potential acquirer? For example, I think I saw First Mining Gold out there. I spoke to Dan Littleton a couple of days ago. I jokingly said to him, well, congratulations on your EA getting approved, but you looked more attractive before it was passed because your stock went up 77%.
Right.
And so I don't know if that helps one's valuation to get through certain hurdles. Certainly when your stock goes up, maybe you're less of a target.
Certainly, certainly you're less of a target.
Yeah.
I mean, the acquirer is going to look at you and say, a good acquirer, is this accretive or dilutive?
Sure.
And the intelligent acquirers, the Agnico Eagles of the world, want to make sure that they give the shareholders of the acquired company a decent deal, but they want to give their shareholders a better deal. It needs to be accretive. The Abitibi, as we learned last year, is a rare breed. I interviewed Amar Al-Jundi on stage, the CEO of Agnico Eagle, last year. And I was joking with him on stage about the fact that there were some small deposits in the Abitibi that had gone undeveloped through 4 cycles. And I expected that they would be orphans this time. And he looked at me and says, "You're wrong this time, Rick." And I said, "How's that?" He said, "Because there's so much more infrastructure in the Abitibi, so many more process facilities, that a 700,000 ounce deposit that can't amortize its own mill can be attractive to me because I already have a mill. If I can truck that material to my mill, I don't have to build a mill there." He said, "What's changed in the Abitibi is that the roads are in, the power's in, the water's in, and the processing infrastructure is in. So there's 5 or 6 natural acquirers in the Abitibi that didn't exist in the last cycle."
Yeah.
Interesting point of view.
Final question. You have a service which you provide to the general public, which is to rank their mining stocks. Some of these mining stocks presumably did not make it to your list at the Rule Symposium. Why are those companies not here? In other words, can you identify a few recurring themes which would eliminate a company from being bought into your portfolio?
A very small company has to have a superb management team.
Yeah.
And there are not very many.
Okay.
So if the company has a management team that doesn't have a proven track record of success, and success that's applicable to the task at hand, they're not invited. If somebody's success was that he or she operated a gold mine in French-speaking Quebec in 2 billion-year-old Archean terrain, but the task at hand is exploring rather than producing, for copper-gold porphyries in 15 million-year-old terrain in Spanish-speaking Peru, well, they were a success. The success isn't applicable to the task at hand.
Yeah.
So I want management success, and I want management success applicable to the task at hand. The second thing that I want is scale. Both big and small mines have big risks, but big mines make you big money and small mines make you small money. So the idea that I would take a big risk for a small amount of money is a non-starter for me. I'm just not interested. I need scale. The more scale, the better. I want companies in the exploration phase where, if they're successful, the target size is such that it's a tier 1 deposit. I define tier 1 deposit as at least $10 billion in situ value. That would be in the lowest quartile in terms of AISC and the best quartile in terms of return on capital employed. Those are rare. Those are very rare. And the third thing is when I ask the company how they're going to add value, what the most important unanswered question is, they have to have an answer, I believe. In fully 80% of the time, when I have asked companies to describe the principal unanswered question, the CEO has looked at me quizzically and said, I've never thought of it that way.
Sure.
That suggests it's going to have, it's a very, very, very difficult job to add value if you don't know how to add value. And what the person just told me is that for him or her, the unanswered question is whether they get a payday in 18 months. And while I understand that's important to them, it's not to me.
Yeah, makes sense. Well, I appreciate you taking the time out of your very busy afternoon to speak with us, Rick. And once again, we are at the Rule Symposium, so thank you for hosting us. Where can we learn more from your work if you're not already attending the conference currently?
The best place to get to know me is Rule Investment Media, my website. If you go there and list your natural resource stocks, I personally will rank them 1 to 10 for free, which is a very good price. 1 being best, 10 being worst. I'll comment on individual issues if I think my comments might have value. That's Rule Investment Media. List your natural resource stocks. Please, by the way, no crypto, no tech stocks, no pot stocks.
Have you ever rated something 10? Have you ever given out 10s?
Yeah.
9s or 10s? Okay.
Yeah.
Well,
yeah.
Are the ratings public? I'm just curious. Like if you
go to the Rule Classroom,
okay,
it tells you how I rate and how I rank.
Okay, excellent. Okay, well, go there. We'll put the link down below. Thank you very much, Rick. Thank you for hosting us, and thank you for coming on the show. Thank you for watching. Don't forget to like and subscribe and follow Rule in the links down below.